So good morning. My name's Matt Harry. I'm an investment partner at Apollo Crypto. I'm here this morning to bring you a fairly, what we would consider entry-level presentation, mostly in relation to what Bitcoin is and how it works. Some of you may be a little bit beyond this level in your journey, and that's fine. You don't have to stay on for the whole call. Those of you that aren't, I think it's a really good opportunity to get the basics down. There will be an opportunity at the end also to ask some questions, and there are no silly questions, so please feel free to do that. You will notice that the deck itself is a little content heavy, perhaps a little wordy. We've done that on purpose so that we can send that through to you after the session. And for those of you who are new to this space, it'll be a good way that you can remind yourself of what we covered off, because some of the concepts, when they're kind of piled on top of each other, can be a little overwhelming if you don't have a reference document to come back to. So we'll jump in. So in terms of the team at Apollo Crypto, I won't bore you with the full details of all of the members of the team. You can read in your own time this particular slide. I actually need to update this. Matthew Harcourt has recently left the business, but we have a new head of research and portfolio manager that's come on. Prateek Kala, who those of you that have been in this industry or interested in this space for a while will more than likely know. He's a regular on AusBiz. He has worked for other fund managers in this space, and he's had a lot of success in steering those portfolios to record results. He was also instrumental in the creation of the first Bitcoin ETF here in Australia that's gone live recently. So we're very lucky and very excited to have Prateek come aboard. And then under Prateek, we have Juan, who is a very talented crypto analyst, and Quinn Papworth, who's also come on full-time as well. But in terms of the portfolio management, I should say in terms of Henrik as the CIO, he has 17 years global financial markets experience across 3 continents, including 10 years on Wall Street, where he worked, among other things, as a technology analyst. He's an honorary senior advisor to the Faculty of Business and Economics at Monash University. He's co-founded a couple of crypto projects himself, and he's also worked as a quantitative analyst for a long-short hedge fund in Singapore. He's been running Apollo Crypto since late 2017, with the first portfolio launching in February 18. And then we also have Mark Woodward, who is kind of he's had 20 years as a tech venture capitalist. He's a career funds guy. He also has a material impact on the direction of the portfolio. And then less importantly, myself and Brad Sewell, who, for want of better terms, are sales and distribution guys. So that's the team. I'll update this deck before I send it out to you. So starting from the ground up, Bitcoin was created in January 2009 by an anonymous creator that goes by the name Satoshi Nakamoto, who you've probably heard of, as a response to the GFC, as a way that individuals could regain control of their financial sovereignty. Financial sovereignty is extremely important to millennials who have grown up in the shadow of the GFC. They trust technology almost implicitly, and they have a general distrust for financial institutions. That's an important point, and we will come back to that. So Bitcoin enables the transfer and storage of funds or wealth without restrictions in a fast, cheap, and highly secure manner. In fact, the Bitcoin computing network is the most powerful and secure computing network on the planet, which many people are not aware of. So it has proven itself, Bitcoin itself here, we're referring to just Bitcoin at this time. It has proven itself as an excellent store of value asset over its 15-year history. I think you're all aware of the astronomical growth. Yes, it's been volatile, but if you zoom out, it has been an excellent store of value asset. And we'll come back to why that is. It has zero weight. It cannot be counterfeited. It is highly divisible, up to 100 million places, non-sovereign and very secure. So exhibiting excellent attributes of sound money. And in January of this year, we saw the first spot Bitcoin ETFs gaining approval under the SEC in the United States. That was huge. It was a really big moment for, allowing access to institutional investors to the space with regulatory certainty. Those ETFs have actually been the most successful ETFs ever launched. In fact, the BlackRock IBIT Bitcoin ETF now holds more dollar value than its gold ETF, which is just a mind-blowing statistic. So demand has been huge for this asset class since it became easier to access. So the first gold ETFs took over 5 years to reach 50 billion in AUM. The Bitcoin ETFs took just 57 days. So the demand for this asset class and this particular asset as a store of value asset with asymmetric returns for the last 15 years is incredibly compelling right now. Okay, so Bitcoin's often compared to gold due to its hard store of value and non-sovereign nature. It is increasingly being seen as a hedge against inflation and sovereign risks associated with government-backed fiat currencies. So when we speak of centrally issued or government-backed money, the reason why all forms of that type of money have failed over the millennia is due to the ability of the controlling entity or the government to simply increase supply. That can't happen with Bitcoin. It's non-sovereign, so it's beyond the reach of governments, and it has a hard capped supply wired into its code, if you like. So the properties that make gold a strong financial asset, such as durability, inflation resistance, and limited supply, are all exhibited by Bitcoin, but to a greater degree, with some additional advantages over gold. So you can see the table there on the right, Bitcoin versus gold versus fiat. Fiat really, traditional currency, money, is really the worst choice of all three in regard to being a store of value asset. So there is a couple of things around Bitcoin which make it a more compelling investment case than gold. So if we're talking about scarcity, specifically in relation to scarcity, Bitcoin's issuance rate is currently 0.8% annually. That'll continue to decline with future halvings. I'll go into what the halvings are in a minute. Whereas gold has an issuance rate of around 2.3%. And as gold price increases, I should say, so does the amount of gold being mined. So there's kind of a reflexivity in supply and demand. Gold price goes up, so does the amount of gold that's being mined. Not so with Bitcoin. The supply rate is fixed and cannot be changed regardless of the price. In terms of scalability, transacting with gold is really slow and expensive. Bitcoin can be sent over the internet almost instantaneously. And as I say, it's consistently being considered a hard store of value internet money for the digital age, something we'll also touch on a little later. Also, verifiability from that perspective. Bitcoin transactions are verified by the network and achieve finality within an hour. Gold verification is costly and time consuming, and there's always been issues with the counterfeiting of gold. There was one quite notable case back in 2020, King Gold, I think out of Hong Kong. It was a $2.8 billion counterfeiting scandal. That is not the case with Bitcoin. So in terms of adoption, and returning to millennials for just a moment, because they are an important part of the picture in considering investment preferences going forward. So we do consider millennials digitally native, and surprisingly for many, and I think this stat could be updated to something even more impressive currently. This is from back in 2019 during a crypto bear market. The 5th largest holding in Bitcoin, in millennial portfolios at that point was Bitcoin. Millennials have just ticked over as the highest income generating demographic also, and they are set to inherit close to 70 trillion US dollars from their boomer parents over the next 6 to 7 years. So really relevant to what will drive the investment landscape going forward in relation to their investment preferences. As I said, they've grown up in the shadow of the GFC. They have a mistrust of financial institutions, but they also trust technology implicitly. And it's very clear that they are comfortable holding value digitally. So really relevant to where we see this asset class going over the next 10 years. Seeing increasing institutional and sovereign participation. It's no longer Bill and Ben, the crypto men. It's now BlackRock, Fidelity, VanEck. We're seeing Bitcoin adopted as legal tender in some parts of the world, or reserve asset in other parts of the world. And also surprisingly for many, the US and China have the largest government holdings of Bitcoin. And now that the Trump administration has been voted back in the United States, they've been very pro-crypto. There is talk of a possible Bitcoin possibly being a future reserve asset. If that is confirmed, we expect some fairly explosive topside. As it is, Henrik has put a target on Bitcoin's US dollar value for this cycle at 200,000 US dollars. That could potentially become quite conservative if the United States was to come out and announce that they will be holding Bitcoin as a reserve asset. That could trigger similar action from other governments around the world. And of course, we've seen this QE, ECB PEP program, basically global hyperinflation, or the erosion of value in traditional currencies by oversupply. I think the average global inflation rate over the last 3 years has been around 7%. Bitcoin's inflating at 0.8% and reducing over time. And also there on the right-hand side, you can see that Bitcoin adoption is actually happening at a more rapid rate than both the internet and mobile phones in their early days of existence. So pretty compelling stuff. Just a bit of a cute slide here, but it does. That is that fiat or traditional currencies are being inflated away by oversupply, never more so than in recent history. I think this graphic shows the US dollar down to about 3.85 cents of purchasing power relative to 100 years ago. As of 2020, I believe that's now down somewhere in the 2-cent range. And you've got US national debt growing by $1 trillion every 100 days. They absolutely cannot pay that off. They need to inflate it away by printing more dollars. And we are currently seeing a re-expansion in global liquidity, silently bubbling away in the background. And this has been very supportive of risk assets in the past, which Bitcoin and crypto are certainly considered. In terms of the current size and what the opportunity looks like going forward, the current size of Bitcoin versus other markets and cryptocurrency more broadly. In terms of the current size of Bitcoin itself, Bitcoin currently making up 60%, around 60% of the total market cap of crypto at 1.8 trillion US dollars versus something like gold at 16 trillion. If the properties that make Bitcoin a superior store of value asset do indeed see it replace gold as the preferred store of value asset, then you can see just relative to gold alone, there is potential for a lot of growth ahead. When we talk about the broader crypto market, currently around 3.2 trillion compared to something like equities, as an example, considering that there are efficiencies in crypto that the equity markets don't exhibit, like a 24/7 marketplace, global access to global liquidity and instant settlement. These things should see the market eat away at a significantly larger share of global equities, in our opinion, in coming years. So when we also consider growth in tokenization of real world assets, which has been a big talking point of late, many of the top investment minds are considering that area as a major growth area in crypto. we can start to imagine that there are potentially many multiples in growth in coming years. It's entirely possible, not to mention the now sort of favourable regulatory environment in the US with the election of the Trump government. All right, so Bitcoin halvings and the mining process. This kind of brings some people unstuck, but if you break it down into sort of bite-sized pieces, it's quite easy to understand. So you're all aware of the term blockchain technology. So Bitcoin runs on blockchain technology and it is issued and secured by the mining process. So simplistically, if we think of a blockchain, if you think of a traditional database where it's stored somewhere central, there's a single point of failure for a nefarious actor to hack into that database. With a blockchain-based database, essentially there's an individual copy of the database stored in all of the individual computers that make up the network. So in order for a nefarious actor to hack in and change something on that database, effectively, they would need to hack into all of those member computers simultaneously. So virtually impossible to do. Makes the Bitcoin blockchain extremely robust and secure. And as it grows, it becomes more so. So Bitcoin mining itself is the process of verifying transactions on the Bitcoin blockchain by solving mathematical equations through the use of computational power. So basically, you've got all these computers around the world all racing to solve a mathematical problem. The computer that solves the mathematical problem, for want of a better term, is awarded Bitcoin, and that's the issuance process of Bitcoin. So successfully solving the mathematical equation results in the placement of another block in the Bitcoin blockchain and the issuance of new Bitcoin to the successful solver. That's happening around, on average, about every 10 minutes. So anyone running the Bitcoin software can verify that those transactions are valid before they are approved. This is known as the proof of work consensus mechanism. So you need a 51% of the Bitcoin network to agree that the solve is actually legitimate before any Bitcoin will be issued. So the rate at which this new Bitcoin is being mined or issued into the markets is predetermined and hardwired in code, and it undergoes a halving every 4 years. So at a point in time, which this year was April of 2024, the amount of Bitcoin that's being issued into the market every 10 minutes is halved. So previous halvings have created supply shocks that have precipitated major price appreciation in the 18 months subsequent to those dates. Basically, what you see from a mining perspective, Bitcoin miners, their revenue model is to mine Bitcoin. Once they get the Bitcoin, they sell it into market. That's their revenue model. So if that sell pressure effectively is halved at a point in time, you see this supply shock and price responds accordingly, as it has done previously several times, which I'll show you graphically here. So in terms of what it's meant, what the halving has meant for Bitcoin price appreciation previously, you can see the halving in 212, 216, 220, and more recently this year. The crypto markets have operated historically in a cyclical nature tied to this 4-year halving cycle. So the April 2024 halving saw block rewards for Bitcoin miners being halved from 6.25 Bitcoin to 3.125 Bitcoin every 10 minutes. So it has the potential to create a supply shock at the same time as we're seeing significant inflows into Bitcoin ETFs, creating a significant increase in demand. So it's kind of a perfect storm. And when you put it against the macro backdrop and also the kind of regulatory or political landscape, we're expecting explosive moves in the next 12 to 18 months. So you can see the 2012. So these yellow vertical lines, they're the point at which the halvings happened previously. Market trades sort of sideways for a few months in 2012, takes off for a huge run of, 10,000%. Likewise, 2016 takes off 3,000%. 2020 trades kind of firmer and sideways for several months and takes off 700%. We're expecting huge things. And indeed, this move has already started to play out with Bitcoin recently, well, at least on the CME, touching $100,000 per coin. Other trading venues, spot trading venues, slightly lower, but we are expecting huge things this coming 12 months. So not necessarily early in as an investor to this asset class, but still early enough in this cycle to enjoy some really significant gains over the next 12 to 18 months. And look, we think beyond that point, this cyclical kind of huge run up and then, major kind of drawdowns, we think this kind of starts to be less relevant now that we have these listed products with daily liquidity, because there'll be an underlying daily level of passive demand coming through from those products. And those products are set to expand as well across other assets within this asset class. So we think the cyclical nature reduces over time, but we also think the opportunities for multiples on triple-digit annual returns also reduce over time. And we think the next few years will kind of be the tail end of that potentially, certainly moving into the broader market beyond just Bitcoin and Ethereum as an example. So Ethereum's so Ethereum went live. This is the second largest crypto asset by market cap. Went live in 2015 and really changed the crypto landscape forever. So Ethereum introduced for the first time programmable money. So it's smart contracts that can allow individuals to transact directly without the need for middlemen. So it dramatically lowers costs and increases efficiency. So developers can code and deploy smart contracts directly onto the Ethereum network in order to build decentralized applications that are governed by code. So no need for middlemen in there. A smart contract allows commerce to be executed via code without the need for middlemen. The biggest use so far has been in DeFi, or decentralized finance, which Henrik is very deep in and understands on a very granular level, and has had a lot of success in investing in the past. So we're seeing things like peer-to-peer lending and borrowing, and earning of interest on protocols like Aave as an example. The arrival of decentralized exchanges, wallet-to-wallet infrastructure on things like Uniswap and Jupiter, which is a new DEX, as we refer to them, or decentralized exchange, which is built on Solana. And we're seeing things like peer-to-peer derivatives as well. Projects like Synthetics, which is an Australian project that allows users to deal financial derivatives directly without banks or brokers taking ridiculous margins. If any of you have worked in that space before, you'll understand what I mean. So Ethereum's mainstream moment, I should say, happened this year also, much like Bitcoin. So on the 23rd of July, we also had the SEC approved spot Ethereum ETFs go live in the States. Huge moment, very much marking Ethereum's status as a commodity and thereby suitable for institutional allocation. While Bitcoin's appeal is in its scarcity, Ethereum's appeal is very much in its utility. So it exists as the global infrastructure platform that gives exposure to and derives value from decentralized applications that build on top of the network. So Ethereum is very much a bet on the future growth of decentralized commerce. Some of our favorite use cases are decentralized finance. To emerge from decentralized finance are listed there. And we come down to the bottom here, non-fungible tokens. Many of you may think of those as kind of JPEGs of monkeys and things like that. That's not how we see them. We think NFTs are really exciting. For the first time, they have solved for secure, verifiable, and almost instantly transferable online ownership. Very much applicable to real-world assets, fractional ownership, and creator content ownership. Not to mention their utility in standardizing ownership across the gaming space. So great technology, still really yet to find its feet, and hence some great investment opportunities. So in summary, why investing? So basically, we're seeing falling trust and changing demographics. So most of the wealth and income generation, as I said, set to sit with millennials. They trust technology, they distrust institutions, they're comfortable holding value digitally. Really important. We're also seeing an increase in digitization. An increasingly digital world requires a digital economy with secure money, identity, and ownership. Not to mention, obviously, the attractiveness of a hard-capped money in a world where we're seeing the Ponzi scheme, which is fiat currency, being debased into oblivion. So we're also seeing significant decentralization and the removal of middlemen across inefficient business and societal constructs, and developing the ability to capture the value we create online ourselves rather than signing it over to large corporations. So this is where we're heading. And this is why crypto has been the best performing asset class for the past 15 years. I don't think it's any longer justifiable to sit on the sidelines with zero exposure to this space. Becoming very tricky to be having a portfolio that's not benefiting from this growth of the last 15 years. And of course, as I mentioned, there is plenty of evidence showing that digital is growing quicker than the internet and mobile phone technology did in the early years. So digital revolution started with the creation of read-only internet, things like blogs. Web 2 was in centralized online services where you could read and write, social media, traditional online business models. And the third wave, Web 3, enables ownership over the contents and assets you use on the internet through efficient peer-to-peer value transfer, allowing for more inclusive economies. There's a fairly compelling case mathematically for allocation. We believe every modern investment portfolio should include a modest allocation to crypto assets. There's been a lot of research that shows that just small allocations to crypto in traditional 60-40 portfolios can dramatically improve risk-adjusted returns. So we're starting to see institutional players seeing the value of crypto in client portfolios. Firms like BlackRock, Fidelity, Morgan Stanley, all saying they're likely to start allocating to client portfolios in the near term. And I think for those of you that are on the call that are advisors, I really now think we're seeing the shifting sands of risk away from, we don't advise on crypto to, clients now saying, why did I have zero exposure to this asset class for the past 15 years while it's basically been up and right? And we're starting to actually see some of the PI insurers also loosen up and allow advisories to allow access to this asset class for their clients as well. So things are really changing in that regard. You see there on the right-hand side, 5% crypto versus 2% crypto, and the green line in the middle, and zero global 60-40 portfolio. So far superior risk-adjusted returns. So as I said before, we believe that future growth in crypto markets, while we still think there's a lot of growth to come in Bitcoin and Ethereum, we do believe that future growth will be vastly captured by future category leaders outside of Bitcoin and Ethereum. But investing in that space clearly still creates some challenges. There's a lot of noise, a lot of scams, a lot of hidden risk. There's unknown or opaque risk in relation to exchanges, OTC providers, and custody. Safe management and storage requires a level of technical expertise. Our portfolios at all times are above 98.5% in cold storage. The assets, we occasionally have small amounts when we're rebalancing and things that are in hot or exposed to some risk. We've had zero security incidents so far in the past 6 years we've been running these portfolios. Succession with direct holdings of crypto is an absolute nightmare. It's cumbersome. There's no perfect solution. Assets are very easily lost or mishandled. And of course, the storage of seed phrases and hardware devices can be onerous and risky. Whereas going through a professional manager like Apollo, you get titled and audited ownership of crypto assets. So you're basically holding fund units rather than trying to work out how to sit all of these individual holdings into a will, for example. Very simplified taxation and succession, economies of scale in relation to custody, technical and administrative services, all movement handled by experienced professionals. And of course, a successful manager can sort through the noise and access early stage opportunities, which Apollo has been excellent at doing over the years. So our solutions, we've got the two funds that kind of sit, I guess, underneath the flagship fund. So the market neutral fund invests in yield strategies within crypto asset markets only, yield farming and providing US dollar stable coins to liquidity pools. Basically, I think that's yielding. You're not exposed to directional price movement there. I think that's yielding around 20% annually at the moment. And the Frontier Fund, which seeks investments in layer one blockchains, interoperability networks, DeFi assets, and NFT infrastructure. This fund also has a very keen focus on seed and early stage pre-token investing in projects within those categories. And I can tell you, having worked for other fund managers in this space over the past 7 years, Apollo was always the business that we would look to as being the best in assessing and accessing early stage opportunities, which we have a good stable of at the moment of opportunities that we've positioned into over the past couple of years while the market has been in a winter, shall we say, that are all starting to roll off over the next 12 months. So then I guess the flagship fund is the Apollo Crypto Fund. So it's an Australian unit trust, multi-strategy, award-winning, offers long exposure to an actively managed portfolio of crypto assets. So this portfolio has Bitcoin and Ethereum included in it, which the Frontier Fund does not. And it also holds positions in the Frontier Fund and the Market Neutral Fund. So it's just a couple of levers that we can use. If we start to see the market topping out as an example, or what looks like it's topping out, then we can dial up the exposure to the market neutral fund, for example, and potentially dial down the exposure in those kind of frontier lower cap gems that we like to get onto. So we've got a few levers here which we hadn't previously had in cycles prior to this one. So Apollo Crypto's edge, as I spoke about, our extensive crypto knowledge has allowed the business to consistently identify strong thought leaders, founders, and emerging trends, or future category leaders, if you like. We're very early into things like Avalanche and Polkadot. At the moment, we've got things like Chainflip, Maverick, Swell Network, Eigenlayer, all sitting in the portfolio at various stages of vesting. Swell Network, I think we actually wrote them their first check and we were an advisor to the project. So all of these things are rolling off in the next 12 to 18 months. So we're highly selective in evaluating new investments and obviously using our global reach network of founders and builders to find the highest quality projects. In fact, Henrik set up an investment consortium of crypto founders in Australia that all work together to support upcoming or emerging products in the space as well. So that gives us great access across the network to early stage opportunities that other providers in the space cannot replicate. So in terms of the outlook from here, we are expecting increases in the ETF uptake and increasing retail interest, which we're starting to see the green shoots of at the moment. So increasing ETF inflows throughout 24 and 25, that's absolutely happening at the moment. Most of the large players are still adjusting risk mandates for inclusion of digital assets, so potentially a huge new source of demand there. Expect increasing allocation from registered investment advisors next year as understanding grows and regulation becomes clearer, probably led by the United States. And we're starting to see growth in social metrics and virality among retail investor cohort very, very recently, just literally in the past month. And of course, those millennials continue inheriting wealth and they're now the largest income generating demographic. We're expecting some regulatory relief. The Trump administration has been strongly voicing their pro-crypto stance. Several have verbally committed to clear regulation and advancement of the space. There's also been talk of that Bitcoin being held as a reserve asset, which would just be unbelievable in terms of the legitimacy and growth that it would potentially provide to this market. Also, potentially supportive macro environment. We've seen recent interest rate pivot from the Fed. We're seeing increasing global liquidity. Crypto's historically benefited and has already benefited from this increased liquidity, I would suggest at this point, as a risk-on asset. And given all of the above, we expect that Bitcoin and Ethereum are very much undergoing their mainstream moment at the moment. So we're looking for, excuse me, significant growth in the near term. We do expect beyond that it will be the second tier assets in the space, or future category leaders, as we call them. That will be the major focus of the next leg of growth as the broader market matures. Apollo works tirelessly to ensure that our portfolios have exposure to the best of these opportunities. If you would like to learn more, I will send each of you this deck from today. My contact details are there. If you'd like to learn more, you can reach out to myself or Henrik. And as I say, I will follow up with each of you one-on-one over the coming week.